Intel stock just fell more than 17% in a single day, wiping out weeks of gains. Just a month ago, Intel was being talked about as a comeback story, supported by the US government, Nvidia, and optimism around AI-driven demand. So, what went wrong? And why are analysts now saying Intel's turnaround is not a clean story? Let's break it down. Why Intel stock rallied so hard? In the month leading up to Intel's fourth quarter earnings, the stock surged nearly 50%. Three major factors drove this rally. First, Intel received strong backing in 2025, including government support and investments linked to US semiconductor strategy. Second, Wall Street became more optimistic that AI data centers would boost demand for traditional server CPUs, a space where Intel still competes. And third, Intel unveiled its Panther Lake chips, built on its latest 18A manufacturing process, which was seen as a major technological step forward. Add to that a supportive social media post from President Trump, and investor enthusiasm exploded. As one analyst put it, Intel stock almost turned into a meme stock. Earnings day reality check. But when earnings arrived, reality set in. Intel's fourth quarter results beat expectations, which on the surface looked positive. The problem was guidance. Intel's first quarter earnings and revenue forecasts came in below expectations, immediately cooling investor excitement. That's when the stock collapsed. The real problem? Supply constraints. One of the biggest red flags was Intel's server chip supply problem. Despite strong demand, Intel admitted it is struggling to meet orders because of internal manufacturing constraints. According to analysts, this points to two serious issues. First, Intel may not be using its manufacturing tools as efficiently as it should. Second, the company may have underestimated how fast AI data center demand is growing for server CPUs. Intel CEO said the company is working aggressively to improve efficiency and increase output, but markets want results, not promises. The disconnect investors can't ignore. Analysts describe a huge disconnect between the stock's recent hype and Intel's near-term reality. The rally assumed a smooth, fast turnaround. What investors got instead was confirmation that Intel's recovery will be slow, uneven, and expensive. Losing ground to competitors, Intel is also losing market share in its core product business. Rivals like AMD and ARM are steadily taking share in both PC and data center chips. This makes Intel's situation more complicated. Why? Because Intel is spending massive amounts of money to run its manufacturing business. But without large external customers, those costs are hard to justify. Despite rumors of potential deals with companies like Apple, Intel still lacks a major outside foundry customer. The foundry bet will take years. Intel's long-term plan depends heavily on fixing and scaling its manufacturing or foundry business. But analysts warn this is not a short-term fix. Intel expects to announce customers for its upcoming 14A manufacturing process sometime in late 2026 or early 2027. Even then, meaningful revenue from those deals likely wouldn't show up until 2028 or 2029. In other words, investors betting on a quick turnaround may be far too early. This is not a one-quarter fix. Multiple analysts agree on one key point. Intel's problems won't be solved in a quarter or two. Turning around a global semiconductor manufacturing operation after years of delays and missteps could take many years, not months. One analyst summed it up bluntly. This is probably going to take 10 years to fix. What this means for investors, Intel's stock drop isn't just about one earnings report. It's a reminder that turnaround stories are rarely straight lines. The long-term vision may still exist, but the near-term execution risks are real, and the market just repriced that risk aggressively. Intel's comeback story isn't dead, but it's clearly far from clean. For now, investors will be watching execution, not headlines. If you want more clear breakdowns of what's really moving US stocks, subscribe for market-focused analysis without the hype.